Houston Real Estate Radio.
Welcome back to Houston Real Estate Radio. I'm your host, Shannon Register, and we are broadcasting from the RREA.com studio over here in Spring, Texas. And I'm really excited to have joining me here in the studio today is Gary Cooper, and he is with Gary & Cooper CPA PC over in Houston, and does a lot of helping people with not only doing their taxes, but planning and doing some tax strategies to help families with wealth decisions and how to manage their money, and just some really exciting things going on. So I wanted him to come on and talk about the importance of planning and some of the things that are new going on with taxes. So welcome to the show, Gary.
Thank you. Thank you for having me, Shannon. I appreciate that.
Well, you came over to our brokerage a few weeks ago and did a great seminar for realtors. It was really fabulous, got a lot of great information, and I think that there are a lot of changes going on with taxes that consumers may not be aware of that we should talk about, and the importance of planning, because a lot of people, there's a lot of stuff people don't keep up with when it comes to their taxes.
Exactly. People don't keep proper supporting documentation. They don't think before year end, and after year end, it's just history. So there's really nothing. Well, there are things we can still do. We can still go back and look at history and come up with good deduction ideas, but it's a lot easier if we're doing tax planning right now for our clients.
Mm-hmm. Yeah. It seems like good record keeping is the hardest thing for me and my family, because we're so busy and going so many different directions. You know, my husband and I have different receipts, and trying to keep track of everything is really hard. So what do you recommend for families? I've heard just have a big box and throw it all in it. Do you agree with that, or you think it should be pretty organized?
I think whatever method is easiest for you.
What works?
Quite candidly, I find it easier to look at things weekly or monthly. Use Excel, use Quicken, use QuickBooks, but make sure you keep the receipts. The IRS is becoming real sticklers. Past years, we could go in, we could take the credit card statements, we could put down the business intent, the person who we actually entertained. They're now saying, no, we want the receipts.
Which seems so odd. I mean, it's right there on your credit card statement showing the amount, the date, where you went, you know, and you can just write in who you went with, and they won't accept that. You've got to have the actual receipt.
Absolutely, IRS code.
And
now, one thing, though, to keep in mind, a lot of people don't realize this, substantiation rules. If entertainment is less than $75, it merely needs to be written in your daytimer or your records, and you can write the intent and the person you entertain, and that meets the substantiation test.
And a lot of those receipts, you have to be careful now, because if you look at them 3 months later, there's nothing on them.
No, there's not.
So you really need to photocopy them or scan them in somehow.
I think a good scanner is really important now, but make sure you back it up. A lot of people will put things on their computer and not have backup and lose every bit of it.
Oh, that's frustrating.
Well, and a lot of our clients give it to us, and then we maintain it on our database, and it's safe and secure.
Yeah. What about the mortgage interest deduction? Is that still available for families?
It is. Congress has always wanted to get rid of it because it's a single-sided deduction, but it is available. And fortunate this year as well, itemized deductions are not limited, so wealthier people can deduct all of their mortgage interest, except you can only have up to $1 million of mortgage debt. So when you get over $1 million of mortgage debt, even on multiple homes, you can only go up to that level for the calculation of mortgage interest.
So if you have an $800,000 house here in Houston, and then you've got a $600,000 property up on Lake Conroe, that's more than $1 million. So
Exactly.
The cap is the $1 million. You have to combine those.
And the IRS now, they've gotten wise. This limitation's been around for a while, but with interest rates been at all-time low, I can assure you, if you're deducting more than $40,000, $50,000 on your tax return on Schedule A for mortgage interest, you will get a letter from the IRS.
It's going to throw up a red flag, huh?
Yes.
What about the home energy improvement tax credits? That was a big thing. That has been something that a lot of people have gone back and retroactively fitted their homes with some energy improvement features and changed out their AC systems to save money on their taxes, because they knew they could get a rebate on it. But that's kind of gone away, hasn't it?
2011. What we're hoping, though, is some of the Bush tax cuts will be put back in place for 2012. But with the election year, Congress, we're unsure. Last year, those changes were put back in place after December 15th. Makes it very difficult to plan.
So when you've already filed your taxes, you can go back and make amendments?
Well, you don't have to amend. It's just before year end, we'll probably know what's going to be put back in place.
Okay.
We're taking everything into consideration with our planning as if and as if not. So we're looking at both sides when we put together a plan for a client.
And with interest rates so low right now, I mean, if you're going to buy a house, this is the time to do it.
I agree.
For sure, the best time to buy right now while interest rates are so incredibly low. Whether you're doing a 15 or a 30-year mortgage, you can get really great rates. And prices are not at all-time highs. They're not at the all-time lows anymore, but they're on the rise, but nothing compared to what they could be.
Well, even a second home, we're blessed. We just bought a home in Galveston in May and received a great interest rate that makes it very practical, very sensible for us. And I think others ought to look at that. You need to look at your lifestyle and see what you enjoy. And I actually had a tax client come in 2 weeks ago, and they do have some money available. They like real estate. They love to fish. And I said, look, I can't tell you anything better than to go down to Galveston, buy yourself a cove house, get yourself a boat, and enjoy life.
Yeah.
Get a tax deduction at the same time.
Yeah, that sounds really good. So, when people ask you if they should pay off their mortgage, do you recommend that they pay off their mortgage, or does it just depend on what their interest rate is on their mortgage, how much they owe? How do you look at that?
Well, this question's kind of like a coin, heads and tails. I'm on the side of the fence where I think people should leverage themselves with inexpensive money. If you can go and you can get a mortgage for less than 3%, after tax, that's about 2%. And I got to believe that you can invest your money and get a better rate of return.
Yeah, real estate is such a good investment, and it's not a fad. It's not a new thing. It's not going away, and it's been around forever. It's just a great investment, solid investment. Would you agree?
Well, they're not building any more of it. And, I think it's an excellent investment. A matter of fact, I purchased my own office building. And as I said, I purchased a house in Galveston. I think with the market the way it is now, we look at our investments and they're pretty flat for the last 10 years. So real estate is a great investment.
Yeah, we don't have the big upswing and downturns like a lot of parts of the country, which is really nice here in the Houston area.
Well, and plus, location, really.
And speaking of location, where is your office?
My office is in the Heights.
Okay.
It's actually Timber Grove, right next to the Heights, in between T.C. Jester and Durham, just north of I-10.
And you service clients all over the Houston area? We
do. We love individuals. We love small businesses. And our goal and objective is to make a difference.
And you really do work with a lot of variety. I mean, you work with realtors, you work with a lot of small companies, you work with some large companies as well. A lot of different variety of who your clients are. And I think that it's great that you sit down with them and help them come up with strategies that will help them save money in the future.
Well, we try to pride ourselves as being consultants and assist with finding deductibility, finding better ways, efficiencies where cash flow can be increased. That's truly our job. Our job is to be a business counselor.
And what about estate taxes? A lot of people want to know what's going on with estate taxes, and really, there's a lot of planning that goes into that.
Well, there's also a lot of procrastination, too. I've discussed this with my clients on more than one occasion. Ones that I believe should go ahead and gift ownership interest in their companies and or liquid assets, with the exemption being $5 million up to the end of 2012. It's a great opportunity.
And that's changing, right?
Yes. It's supposed to change in 2013 back to $1 million, and then the rate's going to be 55% compared to 35% now.
That's a big difference. Big difference.
Significant. And for planning purposes, again, now this tax law could be extended, but some say that's doubtful.
And I think a lot of people lose sight of the fact that it's not just money in the bank. It's your businesses, your estates, homes. I mean, it's a lot of different things. It's not just cash, liquid money.
Well, here's a great example. Let's say that you built a small business. Let's say that it's worth $3 million today. and you can go ahead and transfer that to a family limited partnership to your kids, but you still maintain control. 40 years later, you pass away and that business is worth $50 million, and you haven't performed adequate tax planning.
Mm-hmm.
Let's say there's not enough liquid assets to pay the taxes for the value of the business. The family's going to have to liquidate the business to pay the taxes.
Wow.
That's significant.
That is. So the family could just lose the whole business just trying to pay the taxes.
Absolutely.
Wow. And a lot of businesses are cross-generational. I mean, they cross several generations, so that can be a huge problem and something that you definitely want to think about and plan ahead for.
Well, again, it's like anything else. And what I tell people, your largest expense is probably taxes. And if you don't do planning, and it's also an expense that can be controlled. It's not like a mortgage payment or a car payment. There are ways to control how much taxes you pay because there's deductions, there's tax code, and it's not simple. It's not something that you should be a do-it-yourselfer.
Well, and if it were simple, you would not be in business, right?
No, I would not.
Okay, well, let's take a quick break and have a word from our sponsors, and we'll be right back with a little bit more from Gary Cooper.